staring at a bank screen, doing the mental math, and feeling that sudden, heavy sink in your chest when you realize you might be running out of time. It is a quiet panic that creeps up on so many of us, the nagging fear that we missed the boat on building wealth. You see headlines about 20-somethings retiring early, while you are just trying to figure out how to cover next month's unexpected expenses. That feeling of being irreparably behind can paralyze you, keeping you frozen in inaction while the clock keeps ticking. The truth is that the steepest penalty in personal finance is not a late fee or a sudden market dip, but the invisible compounding cost of waiting. Every year you delay putting your money to work, you are not just missing out on a few percentage points of growth, you are forfeiting the exponential power of time. But believing that it is simply too late to start is the most expensive lie you can tell yourself. Consider Sarah, a hardworking professional who woke up one morning in her late 30s with a sudden, sharp realization about her future. For years, she had done what she thought was right, paying her bills, keeping her head down, and assuming retirement would somehow sort itself out. But when she finally calculated her net worth, the number staring back at her was uncomfortably close to zero. The gap between where she was and where her peers seemed to be felt like an uncrossable chasm. Panic could have easily dictated her next move, pushing her into denial or reckless financial gambles. Instead, Sarah chose a different path, deciding to confront her reality head-on by meticulously tracking every single dollar that entered and exited her life. She realized that catching up would require more than just cutting out morning coffees. It demanded a structural overhaul of her entire cash flow, leading her to adopt a strategy of aggressive savings that prioritized her future self above all else. Real quick, if budgeting and paying off debt still feel overwhelming, I built something to fix that. It is called the Wealth Playbook. It is a simple app where you plug in your income and your debts, and it instantly shows you a budget that actually works and the fastest way to be debt-free. No spreadsheets, no logins, no finance degree required. I made it for exactly where most of us start, from scratch. The link is in the description. Go check it out and let me know your debt-free date in the comments. Before Sarah could effectively build her financial fortress, she had to clear the minefield of high-interest consumer debt that was draining her resources. She deployed the debt avalanche method, targeting her highest interest rate balances first to mathematically minimize the amount of money she was throwing away to lenders. By ruthlessly eliminating these toxic liabilities, she was not just freeing up cash, she was reclaiming the vital runway needed to launch her true wealth-building journey. With the high-interest chains broken, she could finally harness the phenomenon of compound interest. Think of compound interest as your money earning a paycheck, and then those new earnings going out and getting their own jobs to earn even more. Over time, this creates a snowball effect where your wealth grows exponentially, not just linearly. While starting in your 20s gives that snowball a longer hill to roll down, starting later simply means you need to pack the snow a little tighter at the beginning. That tighter packing meant Sarah had to fundamentally shift her lifestyle to widen the gap between her income and her expenses. She downsized her living situation, negotiated better rates on her insurance, and directed every unexpected windfall straight into her investment accounts. It was not always comfortable, and there were moments of doubt when the sacrifices felt heavy. Yet the empowerment of finally taking control began to outweigh the temporary discomforts of living below her means. To accelerate her financial catch-up, she had to understand the critical concept of asset allocation. Asset allocation is simply the strategy of dividing your investment portfolio across different asset categories, like stocks, bonds, and real estate, to balance risk and reward according to your timeline. Because she had fewer years until retirement, she could not afford to put all her eggs in one highly volatile basket. She needed a diversified approach that offered both growth potential and a measure of stability against market turbulence. A common trap for those feeling behind is the temptation to chase massive speculative returns in a desperate bid to make up for lost time. We see people pouring their hard-earned capital into unproven trends or incredibly risky ventures, hoping for a lottery ticket payout. But true wealth is rarely built on wild gambles. Taking on excessive risk when you have a shorter time horizon can completely wipe out your progress and leave you worse off than when you started. Sarah avoided this trap by grounding her strategy in proven foundational principles rather than chasing the latest financial fad. She focused on increasing her earning potential by taking on freelance work and upskilling in her primary career, channeling all that extra income directly into her portfolio. This dual approach of aggressive savings and strategic income generation acted as a powerful engine. It allowed her to pour significant capital into the market month after month, regardless of what the economy was doing. If you are sitting there feeling the exact same weight Sarah felt, understand that the anxiety of starting late is entirely normal. The financial industry often profits off making us feel inadequate or overly dependent on their complex systems. But managing your money and building a secure future is not magic reserved for Wall Street insiders. It is a systematic process of consistent, deliberate actions that anyone can learn and apply, no matter what age you are when you finally begin. One of the most effective tools she utilized in her portfolio was focusing on dividend yield. Dividend yield represents the financial ratio that shows how much a company pays out in dividends each year relative to its stock price. By investing in established, profitable companies that consistently return cash to their shareholders, she was creating a brand new passive income stream. This approach provided tangible, measurable returns that did not rely solely on the unpredictable swings of the broader stock market. The psychological impact of seeing those first few dividend deposits hit her account was profoundly transformative for Sarah. It was no longer just abstract math on a spreadsheet. It was real money, generated entirely by her previous disciplined choices, arriving while she slept. That initial trickle of passive income proved that her aggressive savings plan was actually working, fueling her motivation to push even harder and invest even more. This is where the mechanics of her journey shifted from simple addition to powerful multiplication. By automatically reinvesting every single dividend back into her portfolio to buy more shares, she accelerated the compounding process significantly. Those new shares then generated their own dividends, which bought even more shares, creating a relentless, self-sustaining loop of wealth creation. The lessons from those early payment cycles remained, but now they were working entirely in her favor. Of course, the path was not a perfectly smooth upward trajectory without any setbacks or moments of friction. There were market corrections that temporarily shrank her portfolio value, testing her resolve and triggering echoes of her old financial anxieties. Unexpected life events occasionally demanded cash that she would have preferred to invest, threatening to derail her carefully calculated timelines. Staying the course required a mental fortitude that was just as important as her numerical strategies. Yet the foundation she had built proved resilient enough to weather those inevitable storms. When you have a clear plan and a deep understanding of your own financial mechanics, market volatility stops being a source of terror and becomes just another data point. You realize that wealth building is a marathon, not a sprint, and that temporary dips are simply part of the landscape. The security comes from knowing you are in the driver's seat, steering your own destiny. To maintain her momentum through those dips, she continually optimized her household finances, treating her personal economy like a well-run business. She regularly audited her expenses, ruthlessly cutting anything that no longer aligned with her ultimate goal of financial freedom, while intentionally spending on the things that brought genuine joy. This was not about deprivation, but about profound intentionality. Every dollar had a specific, assigned job, whether that was covering rent, buying groceries, or purchasing shares of her future independence. As the years rolled on, the frantic energy of her initial catch-up phase evolved into a quiet, unshakable confidence. The gap that had once felt uncrossable was rapidly shrinking, filled in by the relentless accumulation of her investments and the steady growth of her compound interest. She was no longer operating out of fear of running out of time. She was operating from a place of power, watching her financial fortress grow taller and stronger with every passing month. The broader economic context reminds us that time in the market is always more effective than trying to time the market. Even starting in your late 30s provides decades of potential growth before traditional retirement age. The math heavily favors the consistent investor who simply refuses to quit, regardless of when they cross the starting line. It is not about executing a perfect strategy from day one, but about executing a good strategy with absolute, unbreakable consistency over the long haul. Understanding the balance within her asset allocation allowed her to sleep soundly, even when financial news headlines screamed about impending doom. She knew her conservative bond holdings provided a buffer, while her dividend-paying stocks continued to generate cash flow, regardless of share price fluctuations. This balanced approach meant she never had to sell assets at a loss just to cover living expenses. Her portfolio was designed to be a durable machine, engineered to survive and thrive across multiple economic cycles. When Sarah finally crossed the threshold into true financial stability, the victory was not marked by a lavish purchase or a dramatic lifestyle change. It was marked by a profound sense of peace, a physical lightening of the stress she had carried in her shoulders for over a decade. She had successfully rewritten her financial destiny, proving to herself that the past did not have to dictate the future. The late start was no longer a defining failure, but simply the opening chapter of a massive comeback story. Your own financial journey might look different, with unique hurdles, varying income levels, and specific family obligations. But the underlying mechanics of wealth creation remain universally accessible to anyone willing to learn and apply them. You do not need a time machine to go back and start investing at 22. You just need the courage to look at your numbers honestly today and the discipline to start directing your resources toward your own freedom tomorrow. Begin by taking inventory of exactly where you stand right now without any judgment or shame about past mistakes. Map out your debts, calculate your living expenses, and find that crucial gap where your aggressive savings can take root. Automate your investments so that the decision to build wealth happens in the background, removing the temptation to spend those funds elsewhere. Action cures the anxiety of waiting, transforming that nervous energy into measurable, compounding progress. The true cost of waiting is not just measured in lost dollars, but in the lingering stress of feeling out of control. But the moment you take that first step, you stop paying that cost and start earning your life back. Your late start is just a delayed launch pad, ready for you to ignite the engines. The best time to plant a tree was 20 years ago, but the second best time is right now. It's called the Wealth Playbook. It's a simple app where you plug in your income and your debts, and it instantly shows you a budget that actually works and the fastest way to be debt-free. The link's in the description. This link in all descriptions. HTTPs, Dividend Playbook. Real quick, if budgeting and paying off debt still feel overwhelming, I built something to fix that. It's called the Wealth Playbook. It's a simple app where you plug in your income and your debts, and it instantly shows you a budget that actually works and the fastest way to be debt-free. No spreadsheets, no logins, no finance degree required. I made it for exactly where most of us start, from scratch. The link's in the description. Go check it out and let me know your debt-free date in the comments. This link in all descriptions. http://dividend playbook, gumroad.com/wealth.